Every Bitcoin bear market ends the same way. Not with an announcement, not with a headline. It ends quietly on an ordinary day when the last discouraged seller finally gives up and nothing happens. Price stops falling, and almost nobody notices for months. Bitcoin has done this 3 times since 2012. 3 peaks, 3 long declines, 3 bottoms that looked obvious only in hindsight. In 2026, the question hanging over the entire market is whether it is about to do it a 4th time, and if so, when. This episode looks at what 12 years of data actually says. First, a definition worth being precise about. A cycle bottom is not a price. It is a process. The moment when selling pressure is exhausted, when everyone who was going to give up already has. Markets bottom not when good news arrives, but when bad news stops mattering. That distinction is the key to reading everything that follows because it explains why bottoms take time. Sellers do not capitulate all at once. They capitulate in waves, and the waves follow a rhythm that has repeated with surprising consistency. Cycle 1. In November 2013, Bitcoin peaked near $1,150, an asset that had traded for pennies 4 years earlier. What followed was a 14-month decline through 2014, punctuated by the collapse of the largest exchange of the era. The bottom arrived in January 2015 near $170, peak to trough, roughly 85% over about 14 months. At the low, the prevailing narrative was that the experiment had failed. Cycle 2. December 2017. Bitcoin touches nearly $20,000 at the height of a retail mania. Then a 12-month grind lower through 2018. No single catastrophe this time, just a slow deflation of expectations. The bottom printed in December 2018 near $3,200. Peak to trough, roughly 84% in about 12 months. Almost the same depth as Cycle 1. Almost the same duration. Cycle 3. November 2021, a peak near $69,000, powered by institutional adoption and pandemic-era liquidity. The decline that followed took down lenders, funds, and exchanges through 2022. The bottom arrived in November 2022, near $15,500, almost exactly 12 months after the peak. But the depth had changed, 77%, meaningfully shallower than the first 2 cycles. Put the 3 cycles side by side, and 2 regularities stand out. Timing. Bottoms have arrived roughly 12 months after the peak, 14, 12, and 12. Depth. Each maximum drawdown has been shallower than the last, 85%, 84, 77. The timing has been stable. The damage has been shrinking. 3 data points is a pattern, not a law of physics, but it is a pattern with a mechanical explanation, and mechanics are worth taking seriously. Now place the current cycle on that template. Bitcoin peaked at $126,000 in October 2025. As of mid-2026, price sits near $64,000, a decline of roughly 49% 9 months in. The 12-month template points to a window in the 4th quarter of 2026. And if the shrinking drawdown trend holds, a decline somewhere between 60 and 70%, the implied zone sits roughly between $38,000 and $50,000. That is what the template says. Whether the template holds is a separate question. Why 12 months? Because capitulation is a human process with human speed limits. Leveraged positions unwind in waves. Each rally recruits new optimists who become the next wave of forced sellers. Miners, the industry's structural sellers, capitulate when price approaches their cost of production, typically late in the decline. Tax loss selling clusters at year-end, and sentiment must travel its full arc from denial through anger to the apathy where bottoms are actually made. 12 months, 3 times in a row, appears to be roughly how long that journey takes. Every cycle, 1 sentence gets people into trouble. This time is different, but some things genuinely are. This is the first bear market with spot exchange traded funds and corporate treasuries as structural buyers. Pools of capital that did not exist in 2018 or 2022. If those flows return, the historical depth may never be reached and the low may already be closer than the template implies. The countersignal measures of institutional demand in the United States have been persistently weak through this decline, evidence that, for now, those buyers are standing aside. Honesty requires the other side. The template could fail late, not just early. Bitcoin's declines have increasingly moved with technology equities, and if the broader market enters a genuine downturn, history suggests crypto bottoms after stocks, which could push the true low into 2027. And the deepest caveat of all, 3 completed cycles is a sample of 3. Structural change only needs to happen once to retire a pattern that small. So what does 12 years of data actually teach? Not a date, not a price. It teaches that Bitcoin's bear markets have historically resolved within roughly a year of their peaks at progressively shallower depths, and that the period after a peak, when attention has moved on and conviction is scarce, is precisely the period long-term participants have historically studied most closely. The template's real message was never when exactly. It was that patience, historically, has been the scarcest asset in the room. Whether the fourth cycle honors the pattern of the first three is something no one knows, and anyone claiming certainty is selling it. What the record offers instead is a map of how this has gone before. 12 months, shrinking drawdowns, bottoms made in silence. The map is not the territory, but it is worth carrying. This has been Quiet Bull. Nothing in this episode is financial advice. It is history offered for study.